All right, today is Monday, July 19th. This is a recap for the stock market activities today. So, this happened today. Yes, a sell-off, a bloodbath in the market, red across the board. But rest assured and hold on to your trousers, pantaloons, underwears, pantyhose, and whatever else you got under there. Hold on to it because the Federal Reserve, led by Papa Jerome Powell, got your back. Stop it with the FUD and put your blindfold on and go back to the casino and buy. This was a mere glitch in the system, a mere glitch in the printing process, and we'll be back shortly. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. Good night.
If you found the information presented in this video helpful, please subscribe, press the like button.
All right, let's talk about it. We've been talking about the bond market mystery. Why is the bond market acting contrary to all of the information we're receiving from the macroeconomics data of higher inflation and higher growth in the economy? In brainstorming all of these possibilities, and by the way, some of you pointed the reverse repo action as having a hand in the action we see in the bond market. Perhaps, and I am aware, I'm not living in a cave, maybe I am, but I'm still aware of the reverse repo operation, of what's going on in that particular market. It has an impact, but boy, this move in the bond market cannot be explained just by reverse repo. We're talking about significant buying from foreign governments, seeking and resorting to quote-unquote safety. And we now know that the Delta explanation is perhaps the most appropriate one for now, because the market threw a fit today and the action was pointing out to Delta fears. Massive sell-off in airlines, travel, cruises, hotels, casinos. Meanwhile, we saw outliers in the action today from stay-at-home stocks. And rest assured, if you came here looking for tickers, oh boy, I got a lot of tickers for you. And we will talk about the stay-at-home tickers in the heat map analysis. We will go over them and I will point out which stocks I like and which ones I dislike in the stay-at-home trade. However, remember, assuming that this is a rotation back to the stay-at-home trade is premature. This is the action from a day worth of activities. Who knows what's going to happen next? Because while everybody's afraid of Delta, you will get headlines regarding what we call vaccine optimism. Pfizer is developing a treatment for Delta, a vaccine specific for Delta. Boom, right there, the market reverses 180, and we're going to see this tug of war between Delta fears and vaccine optimism once again. The point is, building on the discussion from last night, the previous video, the public and the market are both confused on what to believe. There is a significant amount of uncertainty regarding Delta and the vaccines. And we went over all of the data coming out of the UK and Israel, and then the conflicting information between Pfizer, CDC, Fauci, and when there is uncertainty, you always resort to the sell button. And we see sell-offs and panics like we saw today. And of course, the fear in this case is circulating around a déjà vu of 2020, going back to lockdowns. Because in the case of the Fed, we hear the flip-flopping and the lack of transparency. One day, the Fed chairman says, we're way off from tapering. The next day, he says, let's hope and have faith. And the day after, he goes on and says, we're actively considering tapering. So the market has lack of transparency from the Federal Reserve and lack of certainty regarding tapering. On the other hand, when we talk about Delta fears, they're also fueled by uncertainty that the stance on the currently available vaccines, specifically Pfizer and Moderna's, will evolve the same way. The whole we're way off to hope and faith to we're actively considering from the Fed. Perhaps we're going to have all the vaccines are okay, and once you get them, you're Superman, Superwoman. You don't have to worry about getting infected. You don't have to worry about being infected or transmitting the virus. And that evolves to, oh, we're sorry, we found out that even if you are vaccinated, you can still carry the virus. An asymptomatic case, meaning that you could still infect other people. But rest assured, we're not going to have any symptoms regarding these vaccines. Once you get them, you're not going to get symptoms from the COVID-19 virus. And this is also evolving to to breakthrough cases. Did we say if you're fully vaccinated, you're not going to have symptoms? Well, we're finding out that you can actually have symptoms. Okay. And then we're moving on from vaccinated people don't need to wear masks to now the CDC perhaps flip-flopping once again to all vaccinated people need to wear masks also. And then the you don't need another shot, you don't need a booster shot argument will also evolve the same way from you don't need a booster to perhaps you need a booster. And then from no lockdown to lockdown. And this is the kind of uncertainty the market is afraid of. The bond market has been warning of the conditions of uncertainty regarding the Delta variant. And so far, we don't have any certainty because we don't have any transparency. I say if we go back to lockdowns, at least reinstate the $2,000 a month stimulus. That would be nice. But when we talk about the lack of transparency and lack of trust by the public for officials handling the virus crisis, the pandemic, and therefore not getting vaccinated, and even within the vaccinated, also causing significant amount of confusion because we continue to hear about these breakthrough cases. And we don't have any CDC official, any NIAID official, the Surgeon General, nobody is being transparent and answering the basic question. Are the vaccines losing efficacy against Delta due to time? If that is the case, then the solution is booster shots. But if the current vaccines are losing efficacy against Delta because Delta is evolving to evade the antibodies from the vaccines, then we got a bigger problem. And of course, no government official is answering this question, therefore creating a significant amount of confusion. For example, people are resorting to the data out of Israel, which shows that the vaccine from Pfizer loses significant amount of efficacy against the Delta variant. And here we have a Dumbo from the Washington Post saying vaccine doubters, strange fixation with Israel. How about stop degrading anybody who disagrees or has a different view and actually address their concerns? Yeah, what about the data from Israel? Can we discuss that, please? CDC, NIAID, Fauci, Surgeon General, anybody. Can we discuss the data out of Israel? Are they lying? Are we looking at phony data? What's going on here? And of course, they're talking about the news out of Israel that the Israeli health chief saying that vaccine effectiveness against Delta lower than expected. Again, with a lack of transparency, people are going to look for facts anywhere. From Israel, UK, China, the dark alleys of the web, which President Joe Biden says they're killing people. Facebook are killing people. And today he retracted that statement. Is it really Facebook killing people, or is it the lack of transparency from the government? We'll always have dumb people, folks. But again, when you have states and all in all in the country, about 40% of people are unvaccinated, it's not just because they're dumb, but perhaps they have lack of trust in the government and the process. And you're not going to address this lack of trust by mocking them or by inviting Olivia Rodrigo to the White House. And the confusion is becoming evident worldwide. For example, let me read some headlines for you. And this is exactly what's impacting the market today. This confusion and lack of certainty. We're getting headlines, for example, the UK government in COVID-19 confusion ahead of quote-unquote Freedom Day. They have Freedom Day, they're supposed to celebrate, and all of a sudden the UK government is, wait a minute here. Are we celebrating something we shouldn't be celebrating? Are we celebrating a little too soon here? Another headline. COVID vaccine booster shot mixed messaging and confusion over breakthrough cases. The public is confused, the markets are confused, and there is no guideline to address our confusion. More headlines from Tokyo. As Tokyo Games draw near, confusion reigns and COVID-19 spreads. From The Guardian, nightclubs admit confusion over UK COVID rules as Freedom Day nears. Everybody's confused. And now they're issuing passports in the UK, by the way, vaccine passports to go to pubs and nightclubs, concerts, etc. But let's be honest here. The market could give a rat's ass about Delta, Gamma, Beta, unless we're talking about options. But the market could give a rat's ass about the virus, people dying, civil wars, asteroid hits Earth, a mega earthquake, nuclear war, human starvation, that doesn't matter to the market. The market wants certainty regarding one thing. How will it impact my sugar daddy? When we talk about the sugar daddy, we're talking about the Fed, led by Papa Jerome Powell. Will there be a lockdown, economic restrictions, and how will that impact the monetary policy? This is all what we care about. This is all what the market cares about. Because this man, Fed Chairman Powell, has been facing a dilemma and he has been pinned against a corner. He's been playing the argument that inflation is transitory and will pass away. Don't worry about it. We got the tools, bro. But every single data we have received so far indicating that inflation will not be transitory. And this man, Jerome Powell, started to look like a scared man. A man with a target on his back. He has to save his job by next year. And in one hand, he doesn't want to be known as the guy who ruined the party. The economic recovery is going on. We're creating jobs, record high jobs openings, record high equities market, record high real estate market, record high spending and retail sales numbers. If he tapers now to respond to the inflation crisis, the fact that it's not going to be transitory, he risks tapering too early, crashing the market, and therefore perhaps crashing the economy. But the other piece of the dilemma, he also doesn't want to be known as the guy who enabled inflation to rise higher once again since the Jimmy Carter administration, because so far we've been getting extreme inflation numbers. Take a look at the PPI, for example, the highest reading in record. But perhaps Delta came to the rescue for Jerome Powell. Delta slows down inflation expectations. It slows down the increase in commodity prices, and it gives the Fed, Jerome Powell, more time to plan ahead, because the Fed doesn't want to get caught and be forced to taper if inflation gets out of hand. Delta is a God-given gift for the Fed and Jerome Powell. It could rescue his ass by tapering inflation expectations, not the cocaine operation. And Jerome Powell and the Fed get more time to act, but most importantly, plan. And with that knowledge, what are we to do? Market participants and investors, traders, what do we do with this information? If inflation expectations go down, tampering inflation expectations will lead to pushing tapering expectations further down the line. If that is the case, then the US dollar should top. And if the US dollar tops, then we will see a rally in gold and commodities. And that in turn will push yields higher as inflation expectations start to reinflate once again. And perhaps we will go back to a pre-tapering market, at least for a short amount of time. This will only happen if Delta doesn't turn out to be the threat that it is expected from the market right now. It passes with minimum damage, yet it takes down inflation expectations. Now, what if Delta turns out to be a major problem, causing restrictions and lockdowns in this country? Then perhaps tapering will be pushed all the way down the line. Oh, and by the way, inflation expectations collapse. In this case, yields go down below 1%. The Fed starts to add to its asset purchasing programs. Forget about tapering. And the market reverts back to the low yield, low interest rate playbook of picking the NASDAQ, high growth and high momentum, high multiple names. Therefore, ladies and gentlemen, when you hear headlines regarding Delta and Delta fears, what really matters to the market is the monetary reaction. If Delta is a problem, a major problem, or no problem at all, it's all about the money supply. Stupid. And with that understanding in mind, let's move on to cover how the market closed today. And here we go. The Dow Industrial Average down 725.81 points, or a decline of 2.09%. The NASDAQ down 152.25 points, or a decline of 1.06%. The S&P 500 down 68.67 points, or a decline of 1.59%. What about the sector's performance today? Leading the pack at number one, but not capturing any medals because the performances were pathetic across the board. every single sector of the market closed to the downside. But yet, in number one, utilities, number two, defensives, and number three, technology. Meanwhile, leading the massacre today, energy, financials, and materials. No love for the re-inflationary trade at all when we know that Delta is about to be a major problem. This is at least what the bond market is saying, not me. What about the market's internals? The NYSE, 10% advancing versus 88% declining. By the way, when you see this number, this ratio, you know that we have perhaps reached the bottom here. Even if it is a dead cat bounce, a short-term bottom, but these numbers are extremely exaggerated here. Likewise, for the Nasdaq, 24% advancing versus 73% declining. So perhaps a short-term bottom and then resuming the course to the downside. Moving on to futures, the story is in crude oil futures. The WTI was down over 7% today. Massive decline. Likewise for Brent, down about 6.5%. Now, why would you have a dispute to increase supply in the market, to increase output, when you know that we have Delta fears and Delta uncertainty? I'm talking about the dispute from OPEC, which led to the agreement over the weekend to increase supply. And the very next day, we get Delta fears. The very next day, double whammy for crude oil futures, down significantly for the day. What about softs? Lumber. Can you believe it? Lumber closing in the green with gains. And of course, we got news regarding the housing market. Home builders' confidence hits 11-month low. So we're seeing the housing mania, the housing bubble. Some air is coming out. Yet the $1 million question, or billion or trillion, pick your number, is will the housing mania be resumed now that interest rates are going down and perhaps prices go down for a little bit? Will the housing mania resume? And if that is the case, then lower interest rates, lower mortgage rates will lead to higher lumber prices. The rest of softs futures closing in the red today. What about metals? Down across the board. Gold, silver, copper, platinum, palladium, all losing ground today as we saw Delta fears leading to a higher US dollar. What about meats? Perhaps we're back to lockdown mode and we see live and feeder cattle futures rallying higher. Meanwhile, we're seeing lean hogs futures trading to the downside. What about grains? The outlier is wheat futures closing in the green today. Meanwhile, the rest of grains futures closing in the red, led by soybean oil. Moving on to options, the big casino, the hottest table at number one, Apple, with about 1.6 million contracts traded today. About 69% of those were calls. AMC, Ape Land, at number two with 600,000 contracts. About 54% of those were calls. AMC staging a comeback and solidifying 32 as support. We'll talk about that in the charts. What about Tesla, number three, with about 500,000 contracts traded for the name today? About 56% of those were calls. Also staging a comeback, closing at the highs of the day, but not doing meaningful technical repair. What about the unusual trades in the options market today? Starting with the ticker HYG. This is for the junk bond ETF. Cruises, hotels, all of that garbage. The junk bond market is in this ETF. Of course, the sugar daddy, the Fed, has been buying this ETF. But betting against the junk bond market is betting against economic growth and the economic recovery. So this is an important bet. They're buying the 79 puts, expiration date October 15th, with expectations that the name will drop by over 9% by then, and they paid about 35 cents a piece to enter this trade. All in all, spending about $2 million. Lots of bearishness against the reopening trade. Pick your pick. CCL or AAL. CCL, Carnival Cruises. AAL, American Airlines. I'm picking cruises. CCL. They're buying the 18 puts, expiration date July 30th. Notice that these are short-term bets. They're not betting on declines from here all the way to October. They're betting for declines in a week or so. So perhaps we'll get some vaccine optimism if the sell-off continues and the market rebounds, led by the reopening trade. We will see. But in this case, they're betting for more downside, more than 8% by the expiration date of July 30th. And they paid about 33 cents a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker ARKK for Mama Cathy Wood ARK Invest, also known as Tesla Witch Cathy Wood? You might have heard on CNBC and the likes today that yields are going down and therefore RKK is leading the market, closing in the green, yada, yada, yada. But concentrate on what the action today and the fears regarding Delta, how would that impact the monetary policy and tapering expectations, and then make the conclusion whether the market will settle with the high growth, high momentum, the likes of ARKK, or will it settle back to the IWM and the reopening trade. Think about it. But for this trade, the RKK, they bought the 105 puts betting to the downside with the expiration date of July 30th. They're expecting a 10% or more downside for the name, and they paid about 70 cents a piece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker EEM, emerging markets? They're making a bearish bet too against emerging markets by buying the 45 puts expiration date October 15th, with expectations that the name will drop over 15% by then. They paid about 60 cents a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker IWM? Watch out for this one, by the way, because I am watching for a rebound led by the IWM. Watch out for the dead cat bounce here. For this trade, they're buying the 230 calls, expiration date October 15th, with the expectations that the name will drop by over 10% by then. And they paid about $2.65 a piece to enter this trade. All in all, bringing the total to about $3.5 million. Lastly, what about the trade for the ticker INTC for Intel? This is an earnings play. We have Intel reporting on Thursday, and somebody's making a bet here. This is a lottery ticket, really. They bought the 48.5 puts, expiration date this upcoming Friday, July 23rd, with expectations that Intel will drop by over 11% by then. They paid about 13 cents a piece to enter this trade. All in all, spending about $150,000. And of course, they are seeking to double or triple their investment if INTC indeed crashes after earnings. But this is not an investment, it's not even a trade, this is a wild shot. Moving on to the heat map analysis. The picture could not be any clearer. The inflationary trade getting whacked, energy, financials, industrials, materials, but even the technology trade is not working. Apple down big today. We even saw weakness for the dividend-paying names, utilities, consumer defensives, healthcare, all underperforming today. What's overperforming is a few selected names related to the stay-at-home trade, whether we're talking about Peloton, DocuSign, DoorDash, etc. And that leads us, by the way, to tickers, your favorite. I got tickers for you. You wanted tickers? I got tickers and lots of them. Before we go over them, let's address the underperformance of Zoom, because Peloton closing significantly in the green today, but somehow Zoom closing in the red. But remember, the underperformance of Zoom could have happened due to the news that we got today regarding an acquisition of Five9, and Zoom is offering about $14.7 billion to acquire this company. Now, Zoom barely has any cash or profits, but somehow they're going to spend $14.7 billion to acquire a company. But once again, when money is free and created out of thin air, you can make up numbers. So long as you have an equity value for your company inflated by the Fed, you can create money out of thin air and acquire companies. The problem is that that thin air will show up in your balance sheet. So is it really wise for Zoom to spend that much money to acquire Five9? Perhaps this is the reason of the underperformance of Zoom today. But here is the list right in front of you. Names like Costco, Etsy, DocuSign, Zoom, Zillow, Roku, Clorox, Chipotle, Abbott Laboratories, Peloton, Papa John, DoorDash, Kroger, Shopify, FedEx, Wayfair, Amazon, Electronic Arts, or any video game company. Roblox will work just fine. PayPal, Teladoc, among many other names. Now, a disclaimer here. Remember, I'm not saying the market will revert back to stay at home. You cannot make a judgment from 1 day worth of activities. Because for all you know, the market continues to sell off and they come out with vaccine optimism. We got new vaccines for the Delta, Gamma, Squeeze, doesn't matter what variant it is. We're going to make vaccines as we go. And the market recovers and you see all of these stay-at-home names crashing once again. And therefore, my personal picks that I would consider adding to my portfolio right now would be names. Number one, reasonably valued. Number two, will perform either way, but will outperform especially if the market goes to a lockdown mode, a stay-at-home mode. But even if that doesn't happen, these stocks will outperform anyways because they're good businesses at reasonable valuations at least. And these names are Costco, Abbott Laboratories, FedEx, UPS, pick your pick, Kroger, Wayfair, and Amazon. PayPal, not Amazon, PayPal. I would consider adding these if the market continues in this stay-at-home mode and give us clear signals that this will be a trade for at least a couple of months, 3 to 4 months. I already have Kroger in my portfolio and I made a video last year calling Kroger the safest stock. Excellent balance sheet, excellent dividend, cash positioning, and it is a hybrid play, by the way. It plays in a lockdown mode, but it also plays in a growth mode. When we're out and about, you're still going to have to eat. You're not going to have dinner as an NFT. You still have to eat, and therefore, this is one of the safest stocks right now. But again, remember the disclaimer. Don't make any knee-jerk reactions. Wait till you have confirmations before shifting or making major shifts in your portfolio. Confirmation. And that leads us to the technical analysis, studying the charts. Starting with the SPY 30 minutes chart. What's going on in this chart? We had the double top at 438. Since then, we've been flushing down, and now we have this massive gap down all the way to the level I have identified for you last night at 423. SPY flushes down all the way down to the support, to the target of the correction. We're now down about 2 to 3% from the top. Is it enough? Or do we need more? Now, usually, when you see a massive gap down like this, massive bearishness, you're at least going to have a dead cat bounce, at least at a minimum, an attempt to repair the damage. But the psychology is also important when we look at the charts. For example, during the last 30 minutes of the day, we're seeing a massive green candle, a massive short covering candle, indicating that the bears are traumatized. And once they make any sort of profits, they're going to book these profits quickly. I don't blame them. You're not going to lose anything by booking profits, specifically in this mania market. You look at this chart and you see bear trap number 1, bear trap number 2. And if you held your shorts, you're risking that this will be bear trap number 3. Totally reasonable. Now you got to give the market the opportunity to repair the damage. What do we mean by repairing the damage? We mean going all the way, closing the gap at around 430, 431. It shouldn't happen in one day. Be nice if it happens, but it is a process. If at any point of the repair attempt, the SPY reverses before closing the gap, that is the moment that you know the gap. The SPY doesn't have what it takes to close the gap, and therefore it is a shorting signal. So you got to watch out for these signals and these numbers. What do we see here when we switch to the daily chart of the continuous contract for the SPY, the S&P 500? We talked about the negative divergence in the RSI indicator, and now it is playing out. We talked about the bearish crossing in the MACD indicator, and this is being confirmed. Likewise, from a candlestick pattern, we had a confirmation that the market is reversing, and the target was going down all the way to 4,232, and that would be about 3 to 3.5 correction from the top, 3.5% correction, that is. And we got that already. We have erased the entire gains of July in about a couple of days. This is how fast and how sharp corrections happen. And this is an important threshold, by the way, for the SPY to keep, 4,232. Because flushing down from that number, yes, you're going to have plenty of support from previous bounces and gaps, etc. But the next solid support will be down at around 4,000. That would be another massive drop to the downside. Therefore, if you are bullish on the SPY, you better pray and hope that this support level will hold. Because when we go back to the SPY, SPY, this is the S&P 500, not the futures, and this is a daily chart, and I'm using the 200 days moving average, which the chart has to go down to and tag. This is just garden variety behavior. This is how the market behaves. It goes down and rechecks the 200 days moving average. This has not happened since last year. It has been over a year since the SPY went down to the 200 days moving average. And if we go there indeed, if this is it, the correction will go down about 10% or more. Now, is it the correction of 10% or more? That remains to be seen. For all we know, this is a pullback for now. We will take it day by day, but once we see the signal that this is not just yet another pullback, but it is the 10% plus correction, we will play accordingly. Here's the chart of the Nasdaq, the Q's 30 minutes chart, once again gapping down, but we are in purgatory. We don't have any significant level of support, all the way down to 344.5. I know there are gaps, there are consolidation points, which will act as support in the short term. The strength of that support is extremely flimsy, and the reason is the chart hasn't spent a lot of time at these levels. The Qs should also attempt to do some repair in the chart by closing the gap and pushing these momentum indicators, the MACD, the RSI, a little higher. But once again, reversing before closing the gap, that is your confirmation that the market has lower lows to go. What about the daily chart? The continuous contract for the Nasdaq, a negative divergence in the RSI, negative crossing in the MACD. We have a confirmation here, and then we have or had confirmation from the candlestick pattern. Once again in purgatory, because the next solid support is all the way down to 14,000. So I see the Qs here, at least from a technical perspective, as the emperor with no clothes. Even though the market conditions, at least the bond market, is favoring growth in the Nasdaq right now. If we apply the same principles from the SPY to the Nasdaq, the Qs, using the 100-day this time around for the moving average, because this is the retracement moving average for the Nasdaq. It moves a little faster than the SPY, so we use the 100 days moving average. We haven't seen a retracement all the way down to the 100 days moving average since May of this year. It is completely within reason for the Nasdaq to go down all the way to the 200 days moving average, retrace and retag and bounce from there. But that will be a massive correction of about 10% or so. So once again, the market is overheated, and it is not within reason that the Nasdaq suffers a 10% correction along with the SPY. This is completely reasonable. We're not calling for a crash. We're not calling that this is the end of the bubble, but we're calling that this is perhaps an opportunity for the market to remove a lot of excess before heading into the third quarter, which we know usually not, shall we say, friendly to the market. We're also heading into earnings season, and heading into earnings season with these bloated valuations will be a problem. Perhaps the 10% retracement will happen after earnings, because people will still cling to the faith that earnings will justify growth, and all of these delta concerns will go away once we look at corporate sheets and realize how strong their businesses are. We'll see. But for now, we're moving on to the 30 minutes chart of the IWM small caps. Hear me out in this one, because I bought call options at the end of the day for the IWM. Playing a bounce, could be a dead cat bounce, could be a dead dog bounce, could be a dead monkey bounce. I don't care. I'm playing for a bounce. Extremely oversold here, the IWM. And while everybody's betting right now against the reopening and the reinflationary trade, the IWM is oversold. Weirdly, we saw AMC and GameStop outperforming today, the meme stocks. They are an important component of the IWM, at least AMC, not GameStop. GameStop plays with the big league right now, believe it or not. But again, oversold conditions, and we're betting for a bounce. Perhaps we will see a bounce in the morning and a 180 right away. I will take profits right away, not hesitate at all. IWM calls, expiration date this upcoming Friday. We're playing for a bounce, folks. And this is the daily chart for the Russell 2000. And look at where is this one trading. It is trading extremely close to the line in the sand. The bears have gained significant advantage in the IWM. But once again, you look at the RSI indicator, we're getting oversold here. We're getting due for a bounce. Well, the 2100 level is the last solid support for the Russell 2000. The IWM, doesn't matter. So if a bounce doesn't happen here, we're going to have a massive problem. And therefore, I'm bidding on a bounce right here, at least for a short-term perspective. And then, of course, we could resume the pain. It'll all depend on how these fears are developing regarding Delta. Shifting to the US dollar. Rallying once again, defying the technicals. And the reason is we're seeing fear, we're seeing panic, we're seeing a sell-off, a resort to cash. But the $1 million question is regarding tapering. For example, what if the Delta variant is a major problem, delaying tapering expectations due to tampering inflation expectations, then the US dollar goes down. Because guess what? We need to print, baby, print. Back to the printer, Mr. Jerome Powell. We're worried, we're feared, we got FUD regarding Delta. And the vaccine is not actually from Pfizer or Moderna, it is from the Federal Reserve, and it comes in the form of more cocaine. That will not be good for the US dollar, and therefore, the potential for a top is close. It depends on how the monetary policy will respond. Watch out here. What about gold? An apology for not covering gold last night. I missed on including the chart, but once again, gold is trading down, even though the US dollar did not cross above 39 and closed there. Likewise, yields are also down significantly today. So what's going on with gold here? Are we in a panic sell-off today? Is this what gold is saying today? This is just a panic sell-off. Watch out, buy the dip, and we'll take it from there. We'll see. But the blind spot for gold is the performance of yields if indeed tapering expectations get pushed down the line. If we are reading the market correctly, and this is a chart of yields, by the way, the 10-year, if we are reading the market correctly, and the recent drop in yields was a combination of Delta fears and tapering fears, well, if tapering fears get delayed, then perhaps yields will pop higher again. That is contingent on the other factor, Delta fears. And I have a hunch here that if we see a sell-off continue in the market, leading to losses 5-6% for the indices, you bet Pfizer, Moderna, doesn't matter what it is, it will come out and say, good news, vaccine optimism, we got it for Delta. We got the vaccine for Delta. Boom, the stock market bounce higher again. Yields recover, yada, yada, yada. We'll take it one day at a time. But we're trying to read the tea leaves here. Looking at the chart right now for yields, it doesn't look pretty at all. Violating the support of 1.28. Once that happened, the floodgates open. And now the possibility is that yields could go down and break the support of 1%. But mind you, breaking 1% will create headlines, and the market is not going to like it because it will be a judgment against economic growth and sentiment in the future. And that will include the SPY, the Dow, the NASDAQ. They will all suffer if yields go below 1%. And yes, there is such a thing as too low yield. What about the TLT weekly chart? We're now trading above 150, the psychological level, the very important psychological level where TLT longs are hoping will ignite a short squeeze rally. We will see the indicators. The momentum indicators from a weekly perspective still have plenty of room to go for the TLT to rally even higher. But the weekly chart, at least for the TLT, doesn't like to create gaps. We have a massive gap here between the last closing and the closing for today. It wouldn't be surprising to me at all for the TLT to close the gap and then resuming the rally once again. But the bond market story will be sensitive to the flow of news, so keep that in mind. What about the VIX? What's going on here? 4 hours chart. We talked about a crossing in the MACD, a positive crossing, which is creating a new pop, a new rally in the VIX. This time around, creating a rally of about 50%. A massive one, trading above not just 20, but almost 25, the next resistance level. In my opinion, this is a little overheated for now for one pop, and usually we see a pullback the very next day for the VIX. The market in return has a dead cat rally, a dead cat bounce, and then we see the 180 resuming the sell-off once again. It will all depend on the support and resistance levels for the VIX, the 20 and 25. If there is a retracement all the way to 20 and the VIX bounces from that level, then we will know that the SPY has a dead cat bounce. So watch out for 20. The play here for, of course, some of you asked me on Twitter, is the move oversold from an RSI perspective in the SPY? And the answer is yes. The expectations are for a bounce. Whether it is a dead or not dead cat bounce, who knows? But the expectations are that we're going to have a bounce, and the way I'm going to play it is by buying put options for the UVXY. And since I have done that, the UVXY and the VIX traded down significantly. And the expectations are if the VIX opens down significantly to the downside, I will close that trade right away. Booking profits, in, out, hello. Goodbye. What about Apple, the big kahuna? What's going on here? Breaking the support of 145 and therefore confirming the reversal in Apple. But taper your expectations here because we have earnings. And once again, I doubt we're going to see a massive correction in Apple prior to earnings. The market wants to wait and see how corporate earnings, specifically from the big cap technology names, Apple, Microsoft, Amazon. If these earnings provide a shelter, then the market will rotate back to these names. And therefore, Looking at the psychology, the likelihood of a sell-off before earnings, possible, but not likely. The next support is around 140. For now, Apple is trading in purgatory. It has some support, some mild support from the previous gap closing at around 142. Again, watch for a rebound and a failure to close the gap. That will be the signal that Apple will go down, leading the Nasdaq to go down as well. And once again, an update on the daily chart for Apple. We talked about this scenario before, that reaching the upper limit of the channel will be a shorting signal, and indeed Apple dropped big, just like it dropped on the head of Newton. Will it go all the way down to the bottom of the channel? We will see. That remains to be seen, and this is a weekly chart, by the way. What about the souffle? Tesla, 30 minutes chart. What's going on here? It's a day trader's heaven. The stock trades below 657. You know the bears have the advantage. You short the stock, you go all the way down, 629. You book profits, you play for the rebound, you buy calls or you buy the stock. It bounces, closing the gap. You close the trade, you take your profits, in, out, hello. Goodbye. The bears still have the advantage, but the souffle is still trading within range. What about tulips? What's going on here? The battle of 30,000 is becoming imminent here, folks. The laser beams. Gather your weapons, your arsenal, your armors, because you're about to fight one another. Not an invisible enemy. You're gonna fight one another. As the tulip breaks below 30,000, we're going to have the paper hands scenario. The weak laser beams. We're going to start slaughtering the strong laser beams. But let's cross our fingers here and hope that BTC will bounce higher, prolonging the battle of 30,000 for a future date. What about Apeland AMC? Re-solidifying the support of 32. The name opened way below that, but we saw a comeback, buying calls, buying the stock, and closing above 32 once again. We've been asking the question, this is a massive steep sell-off, by the way. When will the bleeding stop? The candidate was 32, and now we have double confirmation that 32 is indeed strong support. Is that enough for a bounce for AMC? Well, it depends. The psychology is also important. The apes continue to buy AMC, defending the line on heavy down days. Well, you cannot just buy the dip, folks. You gotta buy it when the stock is trading higher. You gotta continue to buy. The question is, do you have the money to continue to buy? Because now that you have saved AMC once again, trading above 32, who's gonna do the buying now? If everybody's waiting for a dip, if everybody's waiting to add on the dip, isn't 32 good enough? The psychology is important. If the apes agree that 32 is good enough and they start buying the stock, then we will see a bottom formation here and the stock will trade higher once again. It doesn't make sense at all, but who cares? Because the reopening name's getting slaughtered today, but somehow AMC closing in the green. This is a story divorced from any fundamentals. It is guided by the psychology and the technicals. Of course, the last thing the apes want to do is breaking the support of 32 once again. It will not hold the third time. You gotta keep it from this point on. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing important at all. We don't have any significant events, market-moving events, so we'll leave the economic calendar alone. Some housing data, that will be important, and of course the reaction of lumber. We continue to watch if the rebound in lumber is for real or not. But beside that, not an important day from a macroeconomics perspective. But it is an important day from an earnings perspective, because we have United Airlines, Netflix, and Chipotle. Can United Airlines numbers convince the Delta fearful to stop selling airlines and actually buying the dip in United, American, etc.? We will see. Likewise, Netflix, remember the last time around, in the first quarter at least, they have reported profit and cash, positive cash flow for the first time. And when I did the forensics during the earnings analysis for the first quarter, I showed you that the value of the US dollar, the devaluation of the US dollar, was actually extremely beneficial to Netflix due to the currency exchange effect. Now that the US dollar bounced higher, that effect, that positive catalyst, will go out of the window. Yet Netflix been consolidating for a long time, an underperformer among FANG stocks. Any good news, any good numbers, combined with Delta fears, assuming they don't fade away by tomorrow, could blast the name after hours. But remember that the positive catalyst of the US dollar, the currency impact, that's out right now. It's not going to play for this quarter. What about Chipotle? Again, it's a hybrid play. Reopening, stay at home, Chipotle works either way. We're going to see the numbers, the deliveries versus dine in, an update regarding The increase in wages, Chipotle is paying more now. How are the margins? Are they impacting the margins? What about price hikes on us, the end customer? All of these questions will be important to watch for in Chipotle's earnings. Anyhow, folks, this is the real ending of the show because this is all I got for you tonight, and I will talk to you again tomorrow. Good night.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.